Dinesh, do you want to start off?
Yes. Okay. Yeah. Good afternoon, everybody. Thank you for the hSenid Business Solutions Quarterly Investor Forum. And I think Niland will go into the details, but we have actually shared the presentation. And Niland will talk to you about the structure, what it is. And we are excited. We are here to answer any questions and to get any thoughts from you as esteemed shareholders and partners. Over to you, Nilendra.
Thanks, Dinesh. Hello, everyone. Once again, thank you for joining the fourth quarter financial year 25 investor call of hSenid Business Solutions PLC. We are excited to share the progress that we've made on our journey towards being the most preferred HR tech solution provider in emerging markets. Today, we'll discuss our recent achievements, financial performance, and overall strategy to drive sustainable and profitable growth that creates value to our shareholders. The quarterly earnings presentation was uploaded to the IR website shortly after the release of the quarterly filings as per our usual practice. And this session will be fully devoted to Q&A. Before we get into the Q&A, I'll go through a summarized readout of the performance of the fourth quarter. We recorded a revenue of 499.8 million Sri Lanka rupees for the 3 months ended March 31st, 2025, which was a 15% year-on-year growth in LKR terms and a higher 22% year-on-year growth on a USD constant currency basis. The strong performance was driven by sustained growth in the PeoplesHR Cloud business and a notable rebound in new deal closures after several subdued quarters. The PeoplesHR Cloud business continued to lead top-line performance, achieving 22% year-on-year growth in LKR terms and 31% in USD constant currency terms. Even within this segment, the recurring subscription revenue grew 26% year-on-year terms in LKR and 36% year-on-year in USD constant currency. At the end of Q4, the co-exit ARR reached 4.1 million USD, reflecting the consistent growth and momentum in ARR. New deal closures for the quarter totaled $820,000, which was up from almost $250,000 in the previous quarter, more than threefold, with 96% of the business attributed to PeoplesHR Cloud. This growth was supported by renewed momentum in both inbound and outbound sales activities, which improved pipeline generation and pipeline acceleration. Normalized EBITDA margin improved significantly to 7% positive this quarter, up from -8% in Q3, reflecting the combined impact of revenue growth and cumulative cost control initiatives. The company recorded a net profit of 3.2 million LKR, of course, inclusive of non-recurrent foreign exchange gains and the deferred tax asset creation. With this strong finish to FY 2025, we are entering the new financial year with renewed optimism. We remain focused on continuing to scale our ARR with key product development initiatives underway, including AI integration into the PeoplesHR platform. And we continue building the brand across our target and high potential markets. With that, our opening remarks come to an end, and we will now move to the Q&A section. You may use the Q&A function on this platform to type in and send your questions, or alternatively, you can click on raise your hand and post your questions so that we may give you an opportunity to speak and address them on this forum itself. Okay, there's a question already on the Q&A. I'll start with that. Any plans to enhance the quality of infrastructure, and how many PeoplesHR Cloud accounts do you have? So there are two aspects to this question. Sampath, shall I take it, or do you want to?
Go ahead, Dylan.
On the infrastructure, right now most of our cloud customers are hosted on Microsoft Azure infrastructure, and in line with the evolving threat landscape, we are continuing to improve data security, privacy, and various preventive measures against cybersecurity threats. So this is a constant and evolving process, and we continue to upgrade our infrastructure in line with the competitive, the threat landscape out there. In terms of people's HR cloud accounts, a rough number would be about 400 accounts that we have, so companies that we have on the cloud. I'll move on to the next question. What is the company's expectation on the operating expense growth? When does the company forecast to break even? So maybe I'll take that as well. From an operating expenses point of view, if you look at the biggest cost item of the company, that's our people cost, our payroll cost. And if you look at the last, I would say almost 6 to 8 quarters, our payroll cost has been at best flat, if not decreasing. In fact, we are continuing to optimize some of the areas so that we can get better productivity. And largely speaking, apart from inflationary increases, we are expecting to have near flat, particularly when it comes to the payroll cost. From a headcount point of view, I think we mentioned this last investor call as well. We feel that we are confident that we have all the critical resources, except a few sales and marketing resources that we may add in country to take us through very close to the 10 million ARR goal. So bottom line, we wouldn't be seeing significant OPEX growth in the future. From a break-even point of view, as you could have seen in Q4, at an EBITDA level, we've already achieved profitability. So there was a plus 7% EBITDA margin. From a EBIT level, or in other words, operating profit level, basically our expectation is that when our ARR, which is right now at about 4.1 million, crosses 4.8 and close to 5, which should happen in Q2, we would be generating reasonable operating profits. We are expecting this ARR growth to come from the new deals we are closing and realizing the subscription revenue backlog that we have. So the faster we do this, that timeline may get adjusted accordingly. So that's kind of the overall view from a profitability angle. I'll move on to the next question. I think the next two questions are pretty much interconnected. Why did you pay dividends from IPO proceeds? So just to clarify on that comment, I think what was done in September of last year was essentially returning and paying a dividend to our shareholders, which was almost equivalent to the amount of funds that we raised for the purpose of carrying out M&A activities. Given that we have now seen clear results of the organic growth and the efficiency of the organic growth, the view of the management was that there wouldn't be an immediate need to undertake M&A activity to accelerate growth. As a result, a sum of money almost equivalent to the funds that were raised for M&A was returned to the shareholder, of course, in a structure which gave the shareholder the option to either accept it in cash or obtain scrip shares, which was essentially amounting to reinvesting that into the company. There is one more question on the rule of 40. Where are we on that? I think if we can go to the relevant slide. So slide number 20 on the deck that has been uploaded basically shows where we are. And maybe I'll take the opportunity to explain this slide as well. So we are having the valuation, or in other words, enterprise value to revenue multiple on the y-axis, which you can see on the left-hand side, and the rule of 40 metric on the x-axis. The rule of 40 essentially is free cash flow margin plus year-on-year growth in ARR, annualized recurring revenue. If you look at last quarter numbers, we were at 36% USD constant currency ARR growth and a 1% free cash flow margin. So the company turned free cash flow positive in Q4 as well, which you may have noticed on the deck. So on a rule of 40 basis, that puts us at almost 37. However, from a revenue multiple valuation point of view, we are at about 1.8, 1.9. So significantly below where typically peers in the B2B enterprise software space would trade at, and significantly below the trend line that you see. So that itself represents the valuation upside that we've been talking about continuously in our investor calls. And from a long-term perspective, our goal is to constantly beat rule of 40 by maintaining ARR growth at above 30% and exceeding 10% on the free cash flow margin. So that combined will be exceeding 40, which would put us amongst the better performing B2B SaaS companies in terms of benchmarks across the world. So that's the vision and the goal of the company. Sampath, do you want to comment on? I think there's a question on any.
Slide. Yeah, so we don't have any plan to incur CapEx this financial year major investment. So of course, like ongoing maintenance work, machine purchases, and all these things will happen. Cloud infrastructure acquisition depending on the client acquisitions, but there's no major CapEx plan for this current financial year. And next question is, very Lendra mentioned, I think we can reach that milestone in Q3 for sure, because Q2 and we can reach somewhere around, let's say 4.8, that range, so we can pass 5 billion ARR most probably in Q3. So overseas market development activities are happening. So primarily, Southeast Asia point of view, we are targeting 2 markets, as we explained continuously. That is Philippine market and Indonesian market. So we see a good potential in both the markets, and there's a good traction in Philippines and of course, Indonesia as well. With that, so you observe even last quarter, there's a good sales revenue coming from Southeast Asia market as well. So hopefully Q2 onwards, we are expecting a good revenue to come from these new markets. And expansion point of view, the next question is about global expansion. So global expansion point of view. So as we repeatedly mentioned, Philippines and Indonesia becoming one of our critical market in Southeast Asia region. So a lot of activities are happening, especially when it comes to demand generation. And we recruit some of the critical resources, like we got country director for Philippine market. We are in the process of recruiting a C-level person in Indonesian market as well. We got a few sales guys in Philippines already, and placed 2 Sri Lankan resources, one in Philippines and one in Indonesia. So team structures we are creating now. So with that, we are expecting good revenue to generate from Q2 onwards from overseas markets.
Okay, I'll take the next question, which is, if I repeat that, since the rule of 40 is below 40, when do you see a growth of rule of 40? Maybe beyond rule of 40 is the question. And it goes on, you all believe that free cash flow may retain at positive in next quarters as well, post as a question. So on the rule of 40, clearly meeting and exceeding 40 free cash flow margin plus growth, ARR growth is a critical benchmark that we have set for ourselves as a company and as a team. From an ARR growth point of view, like I said before, let me repeat that. Our target is to exceed 30% year-on-year ARR growth on a consistent basis. We see the adequate demand generation happening for us to be able to achieve that. So 30% of a free cash flow, so of a ARR growth is quite achievable from the visibility we have on the pipelines. And then on the free cash flow margin, like I said before, we turn free cash flow positive, but of course just 1% last quarter, Q4, and maintaining free cash flow positivity on a recurrent basis is a primary target for us, and we expect to continue to maintain free cash flow positivity in the coming quarters as well.
So next
I'll read
question
out.
is,
Sampath, maybe I'll read it out for everyone's benefit, and then you can answer. Any enhanced marketing plans plan to capture the Southeast Asia and Middle East Africa market?
So I'll connect with another question, part of the question on the top, company strategy looking like to compete with the peers. So in the market we operate, we identify with whom we are competing. So strategies developed to compete with them, especially like Nilendra mentioned at the beginning, adding a complete new AI layer to our product, so that will enhance the players. On the other hand, markets like Philippines, here the statutory is very complex, like one of the most complex stat in the world. So we managed to achieve that through product development. So right now, our product is fully compliant to Philippine market requirements, especially statutory. So with that, we have a competitive edge, if you really look at, and also we are focusing certain segments. Simple example, we are targeting few industries in Philippines, and we are organizing different activities, outbound activities to reach that market segment, because total accessible market is very high in both the countries, Philippines and Indonesia. So there are multiple activities happening. One is events. We are organizing with different industry bodies to reach those market segments. Same time, there are digital marketing activities happening continuously for demand generation. So we develop a demand generation cadence a couple of months back, and that is well-oiled function now. It is moving good, and because of that, we know there's a good demand generation happening at the moment. That is then both actually digital and other physical activities will give us the right demand for closures during next couple of quarters. On the other hand, MEA point of view, that is Middle East and Africa, those markets are a little slow. If you look at East African belt, there are some challenges, because there's market slowness, but we are working on certain projects. We got some time back, and we are completing those. And we got actually a country manager, sales manager, for Kenyan market. So that person is developing the East African partner network at the moment. So even though it is slow, that's also progressing those market development activities as well in MEA market. But if you look at overall point of view, Southeast Asia market development activities are much better and good traction compared to MEA.
Let me read out. There is one more question, Sampath, on the broader Singapore. Can you comment on Singaporean operations, and can you shed some light on employee retention ratio? I think on the employee retention, let me give the statistics. Basically, our retention has improved to 83%. I think almost 4 or 6 quarters ago, staff turnover was as high as 28-30%. So these numbers have improved significantly, and retention ratio is 83%. Sampath, do you want to comment on broader Singaporean operations?
Yeah, so Singapore, we consider as a hub. Recently we start our Philippine operation as well. Philippine company also subsidiary of Singapore, and Singapore, of course, a subsidiary of Colombo Business Solution PLC. So we use Singapore as a hub. We are not doing much development work, market development work in Singapore, but we use Singapore as a hub to develop the region. So focus market point of view, as I told you, Philippines and Indonesia, and of course we are working with a few other markets like Cambodia and Brunei and stuff like that. But activities happening from Singapore office.
Okay, let me move on to questions further down. I think the question on the African market was addressed by Sampath. There's a question on the product development side. Any product development activities happening now to enhance the quality up to international players like Workday, Paylocity? Maybe okay. I'll address part of Sampath. Maybe do you want to take the first go at it, and maybe then we'll also add on to that.
Yeah. So as I told you earlier, we benchmark our product with industry leaders like SuccessFactors, Workday, and stuff like that. So we keep on improving quality of the product. And if you really look at the release going to happen in June, this month is very interesting product release, with a lot of AI features will come out with that version. So as I told you earlier, we are integrating a complete AI layer middle of the product that will improve the product usability heavily, and also with new UI, UX, and stuff like that, product will be in another level. So at the same time, even we enhance our support portal, to give a better support experience to our global customers. So that's where, we invest time and energy, so technology enhancement, the functionality enhancement, the integration capabilities, and also low code, no code platform we are releasing to reduce our customization effort. These activities will definitely enhance the capability of the product to compete with global players.
And if I may add something to that, I mean, if you look at vendors like Workday, and how would we compete with Workday in emerging markets? I think the main the reason or the secret sauce there is that in emerging markets, players like Workday face a lot of challenges because the rigidity of their product. Whereas when it comes to people's HR, because of the high configurability we have found out in numerous implementations that the customizations and the heterogeneous HR practices followed by emerging market countries that we operate in really fit well with the configurability, the high degree of configurability in people's HR as a product. So that helps us differentiate and stand out in the market with particularly players like Workday. Sampath, I'll read this question out to you. Maybe you can take it. What is the switching cost from HBS's software for a client? Can you tell an approximate value?
So it's very difficult to say approximate value, but if you really look at our overall retention rates remain same, about 95%. So that shows it is not that easy to move to another product because it's years of data, and also value with that data. You can do a lot of analytics now today, AI-driven analytics and stuff like that. Because of that, it is stickiness is extremely high, and also with some of the other values you are bringing with third-party products. So you can further increase your stickiness and make sure clients are continuing with our product.
Yeah, and if I may add to that, sometimes it's not about the monetary value of switching costs, it's the heavy disruption it can cause. Because if you look at a company, there are three usually systems of record, an ERP, an HR system, and a CRM. And you might argue which one is the most important, but HR systems, I would say, is the topmost. That a migration can disrupt a lot of activities. I mean, if you're having your attendance, absence logics running in your HR system, payroll running in it, performance cycles, recruitment happening on the system, core HR information being stored there, migrating can be extremely daunting task. So hence, as a system of record, we have very high stickiness. I'll move on to the next question. Are salaries paid to all development staff fully capitalized and then amortized, or are there specific criteria that must be met for capitalization? Additionally, once the development work is completed, are the related staff costs thereafter expensed directly? So the policy that we follow is that any salaries incurred or staff costs incurred in R&D work for the product, improving the product, adding new features and functions, and improving the value of the product is capitalized, and the balance is expensed directly through the P&L, and the portion that is capitalized then gets amortized over the economic life of the asset. So that's the policy we follow at hSenid Business Solutions. So any maintenance work or bug fixing done typically gets expensed. What are the trade payables in the balance sheet? Balance sheet trade payables mostly consists of payments that we have to make to our infrastructure providers. There may be certain partner payments in the payables line item. For example, we invoice a client, but the partner who is doing the implementation or level 1, level 2 support will get a certain portion of the revenue that we invoice to the client, and until such time cash is collected from the end client, this payable to the partner, whether it is an implementation partner or level 1, level 2 support partner, is not released. So these add up to the payables line item on the balance sheet. We've gone through the questions on the Q&A up to now. Again, let me remind you, if you need to ask a question, you can click on raise your hand and pose a question. I think there's one more Q&A. So this is more of a comment. Really happy and good to see our country's indigenous HR solutions provider is doing well. Looking forward to see the next phase of growth like other tech players. Thank you for the comment. I think as we explained, I mean, Rule of 40 is our performance benchmark. So we are, our target is to make sure we exceed Rule of 40, which is a sum of ARR growth and free cash flow margin, to make sure we stand out from a growth and profitability point of view. Are the apps in the marketplace part of your IP? So we integrate with third-party apps to provide certain unmet needs of our customers in the HR value chain. These are not our intellectual property. These are third-party products where essentially we operate like a toll collector because these products need integrations into the system of record, the HR system, to operate. So we take a revenue share from these marketplace intellectual property that is listed. I think there's a question, what is the go-to-market return now? I believe what you're referring to by go-to-market return is the go-to-market efficiency. So I think this slide on the screen essentially shows that. Again, let me remind you, go-to-market efficiency is measured as total sales and marketing costs incurred for the acquisition of new ARR divided by the value of ARR acquired during that period. So we are essentially at 139%, meaning we are spending $139 for every $100 of ARR that we acquire. In fact, if you look at the Q4 numbers, this Q4 number came down to as low as 80%, meaning we were spending $80 in sales and marketing acquisition costs for every $100 of ARR that is acquired. And we have given two benchmarks. One is private unlisted SaaS companies. This is based on, I think you can check on the notes, based on a survey carried out periodically for private, by surveying private unlisted SaaS companies. And then on the public side, you see the number is about 160%, meaning $160 of sales and marketing acquisition costs for $100. So we believe that we have to internally operate below a benchmark of 120%, meaning spending $120 for every $100 of ARR generated, and driving that efficiency is a top priority for us. I'll move on to the next question. Maybe Sampath, you can address that. With the electricity tariff increases, are there any significant cost increases?
We are not expecting a huge increase, but of course there's a slight grow, like, in the electricity bill effective from June, mid-June, but it's not a major concern.
Yeah, I mean, in our cost structure, I would say that that is fairly less relevant. There's another question on the GTM efficiency ratio. So GTM efficiency ratio essentially means how much of sales and marketing expense, or in other words, customer acquisition costs, are you spending to generate $1 of ARR. I mean, again, let me put a simple example. If you're operating at 100%, what that means is that if you operate at 100% for 2 years, in year 1, you'll bring in 100 in ARR, spending 100 in ARR for that as well. So year 1 P&L, I mean, there is 100 of revenue and 100 of a cost, no benefit whatsoever. However, in year 2, assuming there is zero churn, let's say you bring in another $100 at 100% GTM efficiency ratio. Now, your ARR base at the end of year 2, assuming zero churn, is the 100 you acquired in year 1 and the 100 you acquired in year 2. So that's a total of 200. Yet your cost of customer acquisition is still 100. So keep doing this year over year, and this is at a constant $100 net new ARR addition. And if that number is also growing year on year, you're creating an exponential curve of profitability. So essentially, I mean, if you look at hSenid Business Solutions, right now, every additional dollar of revenue that we bring in as subscription revenue, pretty much 75-80% flows down to the P&L as profits. So I think that's the criticality of the 4.8 to 5 million ARR threshold that we are about to pass in the next couple of months, where beyond that point, the company will be fully profitable on a pure recurring revenue basis, and every additional dollar flows right down through to the P&L. There's a question on the devices. Let me read it out. Sampath, maybe you can take it. We have company devices. Do you offer any systems to help manage locking them down, recording calls, location, etc.?
No, that is not part of our business actually, but we track employees. So you have this location-based tracking feature when it comes to employees, but we are not touching the device area.
I'll move on to the next question. Are there any state entities that are customers of the company? Are you abreast of the new changes the government is doing to the labor laws, and if there are any scope for technological solutions from the company? Sampath.
We work with a set of state-owned enterprises. So there's no major changes happening, like, because stat changes we can always accommodate. That's not a big issue. Like, even the tax changes, like, happened throughout last few years. So we accommodate without any problem, because we maintain multiple countries' tax and stat layers. We don't have any issue of doing that. So we don't see there's impact, like, of whatever changes happening at the moment. So we can, like, provide solutions to local market customers as well, government and both private sector and government organizations.
I think there's a suggestion being offered in future. Could you link a calendar invitation and send everything all at once so as to streamline things? We'll take your comment in and see if we can improve on how we send out the presentations at the end of the quarter. I'll look into that. The next question is about the average headcount of employees in your client companies.
It
Sampath?
depends on the region. Now, if you look at Sri Lanka, that can be between 300 to 1,000 employee organization majority. But of course, we work with almost all conglomerates with big employee numbers. But when it comes to other regions like Philippines and Indonesia and stuff like that, headcounts are much higher because if you look at the population is high, 110 million in Philippines and more than 300 million in Indonesia. So we expect higher headcounts companies. We are working on higher headcount bucket in these markets. So, but I would say between 300 to around 10,000 would be the ideal bucket we would like to work. Of course, we can cater large enterprises as well. You all know largest account is 350,000 employee government of Uganda. So that is the largest account. So small account is 17 employee organizations. So we can cater any size. That's not a difficult task. But I would say majority of customers fall into 300 and 10,000 range.
Let me take the other question. Are you all facing a cash crunch now according to the business model? And if so, can you tell the phase you all are now in? So the nature of the business is that you need to burn some cash to achieve growth, and then that revenue that was acquired flows down into the P&L and cash flow improves. And right now we are at the point, I mean, if you look at the last 4 to 6 quarters, we've been burning cash, we've been free cash flow negative. Last quarter, we became free cash flow positive. In response to a previous question, we mentioned that we expect the company to continue to be free cash flow positive and improve on that going forward on a recurring basis. We are at the point, I would say, at a point of inflection where the groundwork has been laid, the significant upfront costs have been taken, and now with the pipelines that are built, I think it's about for us to execute and get these deals in through the sales pipeline, convert them to paying customers by going through their implementation successfully, because every dollar that comes in right now, a very high percentage of that flows right down to the P&L as profitability. So we are, I would say, just in that inflection point where we are entering that harvesting period. And I also want to highlight the GTM efficiency ratio that we mentioned before, because I mean, if you take a GTM efficiency ratio, and this is the nature of the business being explained, say if you're operating at 140% GTM efficiency ratio, this means that the $140 that you spend to acquire the $100 of ARR, you take a hit on the P&L day one. I mean, it hits you upfront. However, the 100 ARR that you acquire has to go through a implementation cycle, train the customer, onboard the customer, and then gets into full paying mode. So typically there's a lag there between when you expense the customer acquisition cost of the on the P&L and start realizing the return of the work done once the customer is a paying customer who has gone live with the system. And this lag is also what the reason behind what was experienced over the last 4 to 6 quarters in terms of the cash burn. I think we've gone through all the questions on the Q&A.
Yes,
okay, there is one. So are none of these expenses deferred? Capitalization happens in 2 ways. One is the product development expense that I think one of the participants of this call had asked before, part of the product development expense, which is used for R&D activities, is capitalized. Rest of it is expensed. Again, on the customer acquisition side, I would say one rather smaller component is commissions paid for sellers who basically achieve their targets in terms of sales quota. On the cloud business, again, this part is capitalized, but a very large portion of all the costs, I would say a good 80-90% of the costs are running through the P&L. I think we've come to the end of the questions. If there are any more, feel free to add your question on the Q&A or click on raise your hand so that we can give you an opportunity to speak.
There's nothing we can close, right?
I think we've answered all questions. Maybe we can close.
Yeah. So thank you very much, everybody, and look forward to working with you. And if there's anything, you can always reach out to us, and have a pleasant evening. Thank you.
Thank you, everyone.
Thank you very much.